Good morning, everybody. You are watching a live daily market outlook from Windsor Brokers for Tuesday, 12th of February 2012. And the highlights for today go as follows. North Korea made a nuclear probe, nuclear test during the night. Pope Benedict XVI grabbed the headlines after announcing yesterday his resignation and plans to step down. The immediate reaction was the sharp slide of the yen. Also yesterday, as U.S. Treasury official voiced support for Japan's effort to boost growth and deflation. And basically the Wall Street was little changed in the light volume. As yesterday's lack of major economic news gave investors little reason to push stocks higher for now. The top performer remains dollar yen, as the pair rallied further yesterday and posted a fresh high at 94.45, bringing back the overall bulls back in play after a brief corrective action that basically failed to take out the good support and the break point at 92.00. Some rebound on single currency was seen yesterday on comments that single currency was is not over valued, but this was more or less short-lived, as the euro is back under pressure during the Asian session in the morning. The comments on the Eurozone finance ministers also came as on the today's meeting of the ECOFIN European finance ministers, saying France insisted that Eurozone finance officials should discuss the rising strength of the euro, but several ministers played down the issue, and the G7 was expected to call for a market-determined exchange rates. As said, Pope's sudden resignation sends shockwaves through the Catholic world, as the Pope Benedict XVI announced yesterday that he would stand down. He's the first Pope to do it in 700 years, saying that he no longer had the mental and the physical strength to carry on his duties, and he's expected, as he announced, by the end of February to step down. From the markets this morning at the beginning of European session, euro is again under pressure following yesterday's brief bounce higher that failed to sustain gains above 134. We are back within the range of 133.50 and 134.28, with the near-term structure still aligned towards the downside. Sterling remains under pressure currently at the beginning of the day. It's a rather sideways movement within the narrow range, but yesterday's sharp fall and acceleration lower that nearly fully retraced a near-term recovery rally from 156.30 to 158.43. That peaked, pardon, on last week's recovery rally that peaked at 158.43, failing to regain important barriers 158.77, 159.00, and bringing the overall pressure on the sterling. More of this, of course, we are going to take a look in our technical part. Especially interesting situation is with the sterling. Dollar yen, as we said, resumes its strong uptrend. The previous resistance at 94 now acted as support and so far contained the corrective easing of yesterday's peak at 94.45, with the overall bulls still focusing upside barrier at 94.97, May 2010 high, and our near-term target. Dollar Swiss remains well supported for now, following a break above 92. Psychological barrier, 50% retracement, and recent consolidation range top, signaling that possibility of further extension higher of the corrective rally from 90.20 is quite likely at this point. Positive technicals are seen supportive for now. From the other side, the gold remains in the strong downtrend. Yesterday's sharp acceleration through 1663, 60 and 1650 supports dipped as low as 1642. This is basically the previous low of 7th of January 2013, and this signals end of the brief consolidative corrective action, pardon, of 1651, and focus is still to the downside. Especially interesting that yellow metal ignored completely the action of North Korean nuclear test, while the crude oil acted appreciated higher on the jump overnight to 97.07 so far, where the pair is currently holding just slightly below 9700. This is a strong barrier, and we are looking for a renewed test of this level and possible break higher. The yellow metal, the crude oil, pardon, is still within the range, but now the near-term focus is aligned towards the upside, and sees potential for some stronger rally through, stronger action through 9700. That would trigger a possible return up to the near-term barriers at 98 and 98.22. Quite a busy calendar seen today, as the Tuesday shows that a lot of economic indicators are released or due to be released. Highlights from already released: one, house prices balance from UK that came during the night came at -4% versus 0% in December, and -2% pardon, forecasted. Consumer confidence is Japan improved significantly from 39.2 that was seen in December, and forecasted 40.5 with the release seen today at 43.3. Machine tools orders from Japan came more negative, -26.1% in December compared to -21.3% release seen in November 2012, while they were awaiting the release of Swiss inflation that was released a minute ago. We're going to take a look. I don't have it yet, so if you give me a second to get the release, that hasn't been updated yet. The inflation came at -0.03% as expected, so higher than the previous previous December's release at -0.2%. Bank of England inflation letter is due to be released today, and then a number of data coming, which are the highlights of today, from UK. Inflation in January is expected to tick higher to 2.8% compared to 2.7% in December 2012, while the core CPI in January, according to the forecast, is seen unchanged from December at 2.4%. Producer price index input forecasted 0.8% versus the negative -0.2% in December. Similar with the output, that is forecasted 0.3% versus -0.1% in December. Retail price index is seen forecasted slightly above December's release of 3.1. The 3.2% is the today's forecast, and pardon, December's home price index is again forecasted in a positive mode, 2.3% today's consensus compared to 2.1% release of month of November 2012. All these data are due at 9:30 GMT from UK. Then we have the speech of Swiss National Bank Chairman Jordan, that is due at 10 o'clock GMT. At the same time, we have the leading index from UK for January. We have no forecast, as I can see, 0.2%. It was December's release. Another speaker is Bank of Canada Governor Carney, that is due to have a speech at 13:45 GMT. Of course, today we have the ECOFIN meeting in Europe, the second day, and ECB President Mario Draghi is due to have a speech at 15:30 GMT. And another speaker is a member of Federal Reserve's Open FOMC, George, that is due at 16:30 GMT. And this concludes today's data. We have at 1900 federal budget balance from United States for January further drove of $4.6 billion is forecasted in January, compared to the pullback draw of, $0.3 billion in December 2012. And these are the highlights of today's calendar. Quite busy, as we said. A number of releases, especially focus is seen on the United Kingdom's releases, and of course the number of important speakers that are kicking with the Swiss National Bank Chairman Jordan, who is the first in a row at 10 o'clock GMT. And that's basically all from today's fundamentals and news. We're going to turn now to the technicals and see the outlook for the major currencies and commodities. Our structure on the euro is neutral, as we see. The indicators are around their midlines as the pair moves in the sideways mode after finding base at 133.52. That marks exactly 50% of the larger 129. I do apologize. 129.96 to 137.10 up leg, with the corrective consolidative action so far being limited by last Friday's high at 134.28, and also it's descending 4-hour 20 days exponential moving average, keeping the upside so far protected, and basically shifting the focus the downside despite the range trade that has been established. The tone is still aligned towards the downside, as we can see that 4-hour indicators are rather neutral at this point, following failure to regain initial barrier, and the downside remains quite vulnerable at this point, especially that the price again broke below psychological 134 support, and currently standing at around 133.74, seeing more risk towards the downside. Basically, this is a part, this consolidation is a part of the broader downtrend from 137.10 peak of 1st of February 2013, and break below 133.50 that is seen as a break point. Marks a midpoint 50% of the 129.96 to 137.10 rally, seen as a trigger for some further extension of the pullback, near-term pullback from 137.10, with the next support seen at 133.00 as a psychological and round figure, and then more significant comes 132.60-70 zone, where we have the January's higher platform, as well as 61.8% Fibonacci retracement, and also we have the trend line support just below these levels. This is the bull trend line drawn of 126.60 low of November 2012 that currently stands at approximately 132.50. So quite a strong support zone seen on below 133.00 with 132.65 and 132.50 seen as the next significant supports. Descending daily indicators are still seeing more potential towards the downside. Of course, we need to see first the break below 132.50 as, 133.50 as a near-term base. That will trigger further reversal. As said, quite negative tone on the 4-hour chart still favors the downside, unless we bounce higher through minimum 134.40, 134.60. That marks 38 and 50% retracement, especially the later one, as this is also the previous low of 5th of February 2012 at 134.58. This is seen as a initial trigger and a break point for some stronger recovery. Of course, requires first clearance of initial resistance at 134.28 that failed, that yesterday's rally failed to break, and then 134.38, which is 38.2% retracement. As said, more focus is still seen towards the downside, despite we are in the range. The downside remains vulnerable unless we are back above 138 and 134, and 134.28. That would be a signal for some stronger recovery. British pound raised all its near-term gains of last week's base at 156.30. There was a basing attempt and a good recovery rally that gave initial good signal, positive signals after clearing the initial barrier at 158.04, but unfortunately gains stalled at 158.43 last Friday, and since then the pair is in the down move, especially yesterday's acceleration lower through all relevant supports, dipped as low as 156.40, so basically nearly fully retraced the recovery rally from 156.30 to 158.43. From the 4-hour chart, that is still maintaining a negative tone. Slight improvement was seen on the break higher, but the indicators again slid into the negative territory, seeing the underlying bear trend still in play. We're talking about downtrend from 163.80, peak of 2013, posted on 2nd of January, with over 61.8% being retraced so far on a dip to 156.30. Continuation is seen as a quite likely scenario. The notion is also supported by break below multi-year trend line. This is the trend line drawn of 135 2009 low. That was at 157.21, as well as break below the recent 4 months range floor at 158.26. That gives a good signal on the larger picture that possible continuation of the towards the downside is quite likely. Of course, we have the lower range, basically the main range floor levels that are approximately at 152.50 zone, and this is coming into the near-term focus on the larger picture. Of course, we are in the monthly now, as initial signals were given after breaking below range floor and the main bull trend line. Basically, the pair is breaking below the multi-year triangular consolidation that is defined by the trend lines drawn of 170.41 peak of August 2012 through 167.37 peak of 1st of May 2011, while on the downside ascending trend lines commences from 135.01 January 2009 low through 142.30 May 2010 low, and then comes to lows at 152.67 of 2012. Break below this triangle is giving initial signal for possible slide that could extend to the initial good support at 153, 152, 152.30 zone. Back to the lower time frames, negative tone and quite extended conditions on the hourly suggest that some corrective consolidative action may occur at this point, yet no any firm signal for this, keeping the downside vulnerable in the near term. As we said, a break below 156.30 opens 156.00 round figure initially, and then we have Fibonacci 76.4% retracement of 152.67 to 163.80 ascent at 153.55.30, and this is seen along with 156 as the next downside target. To improve the near-term structure and signal firm base, we need to see the gain of minimum 158.43 and 158.77. I would say 159.00 as 158.77 marks the previous high of 1st of February, as well as 200 days moving average. So a lift above 159.00 would be a signal for a base at these levels and allow for some stronger recovery. Otherwise, a more likely scenario is seen of on a fresh slide lower towards 150 through 156.30 towards 156.00 and 155.30, our next downside targets. And our top performer, dollar yen, after is in a slight corrective mode, affected by North Korean's nuclear action after posting a fresh high at 94.45 yesterday, as the corrective pullback from previous high at 94.45 failed to clear trigger and the break point at the 92 zone. The support was found at the 92.17, and then fresh rally and acceleration seen yesterday cleared 94.00, posting a 94.45 fresh high en route towards our next target, which is 94.97 is the high of May of 2010. And basically the regain of this level will signal, will confirm the near-term, medium-term, I would say at this point, base. This is the low of 75.55 of 2011, and confirmation of this base would allow for some stronger corrective action. Break above 95 could easily stretch up towards 100 levels, with interim resistance at 95.72 seen as initial on a break above 95.00. Back to the lower time frames, previous peak at 94.02. So far, this zone so far contained the current corrective consolidative action. This is around 23.6 of the percent of the latest rally from 92.17 to 94.45. However, reversing hourly studies do not rule out some more corrective action. 93.85 is so far the low, reinforced by ascending hourly 20 days exponential moving average. Then comes another static 93.72 high of last Friday, and then we have a 93.58, 38.2% retracement, below which comes close to it is 93.49 ascending 55 days exponential moving average. Any slide lower should ideally hold here in order to keep immediate bulls in play. However, the overall bullish picture will not be harmed by any pullback unless we see the break below 92.00 and then 91.74, 38.2%. I do apologize, this is not very correct. 92.00, that marks the recent higher base and the 38.2% retracement. And this is seen as a trigger to the downside. Any break below 92 is will be seen as initial signal for some stronger corrective action. Otherwise, the pair will continue to head north and focus our initial target at 94.97. And finally, dollar Swiss shows signals of recovery. Yes, a near-term corrective consolidative pardon, action under 92.00 was contained at 91.50, contained by ascending 55 days exponential moving average, and the previous high of 6th of February 2013, with brief break above 92.00, still shy of any stronger action. 92.13 so far seen the highest, with the quite positive tone on still seen on the 4-hour chart, but we need to see the clear break above 92. This is also 50% retracement of 93.87 to 90.20. Descend clear break probably close today above this level is to signal stronger recovery of course a larger downtrend seen of from 95.11, let's say the high of November 2013, which is here, or the overall downtrend from 99.70 peak of 2012. Back to the 4-hour. As said, positive structure on the 4-hour chart favors the upside. We have the 20 days Bollinger Band, upper band at 92.30, and then 92.47 is the 61.8% retracement in case of sustained break above 92.00. In any case, any reversal below 92.00, though the hourly studies are still positive but started to point lower, should in any case hold above at or above 91.50. That is recent range floor in order to keep the positive structure of 90.20 and 90.63 in play for a possible stronger recovery. As said, again, overall negative trend and bears are still in play, and unless we see regain of previous highs at 93.87, 93.81, 93.87, along with the 94.00, not much to be expected of the current recovery. The pair is above now the already broken bear trend line, larger bear trend line of 99.70, but still this recovery could be just seen as a corrective action, producing a lower top and a fresh slide lower, unless we regain outside this point 94.00 to be on the safe side, and this will be a signal for some basing attempt. The reversal is signaled by double doji seen last week, with the recovery attempt now underway. Still the hesitation is evident at 92 level, but holding above 91.50 keeps immediate bulls in play, and sees potential for a stretch towards 92.47 and then 93.00. That marks 76.4% Fibonacci retracement of the down move from 93.87 to 90.20. The gold, as we said, let me just find it, remains under pressure, and a strong acceleration lower ended the triangular consolidative action. Basically the pennant pattern that was confirmed proved to be bearish, and the break below some relevant supports 93 1662, 1660, 1657, and finally break below the low of 28th of January at 1651. Accelerated losses down to 76, below 76.4% retracement of the larger recovery from 1625 low 4th of January to 1697 peak of 17th of January, shifting a focus firmly towards the downside. 1642 low of 7th of January has been tested so far, and the main focus now comes towards recent lows of 1635. This is 20th, 21st of December lows, and the key support and the key low at 1625, 4th of January low. That came now in focus. Yesterday's break and close below 200 days moving average maintains now negative structure, and suppose this notion as gold slid lost important supports, and now focusing key support that may trigger some stronger bearish action. As we can see, the yellow metal is in the firm downtrend of 1795 peak of September 2012, and basically it reversed exactly 61.8% so far of the larger recovery from the critical low and break point low of May 2012 at approximately 1526, 1530 up to 1795, with the focus seen on towards the downside, especially that weekly indicators now broke into the negative territory, and the price failed to clear the main bear trend line of 1795 that is currently standing at approximately 1690. More focus set seen towards the downside, then we expect a test of 1635 and 1625 seen as a trigger for further retracement that may open a 1600 round figure, and this 1590 76.4% Fibonacci retracement. On the upside, the previous supports now act as initial resistances, starting from 1650, then 1657, 1661, 1666. In any case, any stronger recovery should stay capped under I would say 1670 in order to keep the near-term structure, negative structure, fully in play. And finally, the crude oil that we just find it. That regained the ground again, basically is attacking the upper boundaries of the recent range, marked by 95 on the downside and 97 on the upside, as the price action recovered initially from 6th of February, low at 95.00, and being capped by 97. Fresh weakness retested this yesterday, followed by quick recovery that is now testing the upper boundaries at 97.00. At this point, 4-hour indicators are slightly improved, moved above, but already started to point lower, as this is basically acting as quite a strong resistance, and we have so far seen approximately 61.8% retracement of the down corrective pullback from 98.22 down to 95.00. A break above 95 is, 97 is required to resume the recent recovery, to signal upside break of or out of the range and refocus 98.22. Otherwise, failure, repeated failure to clear 97 would bring the price action back into the range. Good support seen at previous highs at approximately 96.55, reinforced by 55 20 days exponential moving averages that are close to each other. No bullish crossover yet as the price still holds below 97, while hourly structure showing indicators coming out of the overbought territory that signals further hesitation at 97.00 strong barrier. That was all for today. You can submit now your questions, comments. I do apologize. There was a question for Aussie dollar. Let me just find the chart. Okay, if we start, definitely the pair is in the strong downtrend of 106 zone, the upper boundary of the larger range with a strong descent lower. Ichimoku studies are firmly bearish, price below the daily cloud base, daily Tenkan Sen, the daily Kijun Sen is now emerging out of the cloud, overall pointing towards the downside and looking for test of the lower boundaries of the recent of the, I would say, short-term range defined by on the downside by 101.50, on the upside by 106.20. This is the higher points with the recent peak seen at 105.97. This is the high of January 2013. Since then, the pair is in a stronger downtrend. The initial signal was given on the break below trendline support at approximately 104.25. This is also 38.2% retracement. Then losing another important 103.43 low of 26th of December, 103.20, 61.8%. And finally, the break, yesterday's break below 102.54. That is 76.4% Fibonacci retracement of uplift from 101.48 to 105.97. Of course, losing the 200 days moving average at 103, keeping the focus firmly towards the downside. Also, the low of 23rd of October 2012 at 102.35 has been tested so far, and basically opening way there is no significant supports until 102 and 165 en route to 101.48. Now let's take a look at the lower time frames. Bears remain fully in play in hourly chart, and all indicators are still pointing lower. That shows potential for further extension lower. Similar with the 4-hour, although we are showing some signals of bearish divergence at this point. We can show it. I do apologize. We can show it like this. On both RSI and, I do apologize, on RSI and the MACD there is a bearish divergence. That could be initial signal for some corrective action. Yet indicators are still in the descending mode despite being quite extended, still showing no signals of reversal. So at this point we will be still looking for test of 102 and break down for final stretch towards 101.50 hour downside target. Any corrective action faces good barrier at pardon, 103 and 103.50, which is the previous high of last Friday, reinforced by descending 55 days exponential moving average. Any break above 103.50 would delay immediate bears, but this again could be seen as just corrective, I do apologize, corrective rather than any more significant action. Corrective preceding fresh weakness. Overall picture is still very negative for Aussie dollar, and main focus, as we said, at recent low and range floor at 101.48, low of 8th of October 2012. Any further questions, please? Okay, if not, then I would like to thank you all for attending our sessions. Invitation, of course, for tomorrow's one, which will be Wednesday at standard time 8:00 GMT. Until then, I wish you nice Tuesday. Keep an eye on the economic indicators that are in a big number to be released today. And of course, I wish you very successful and profitable trading. Good luck.